This Week in Startups is brought to you by Right Networks. Over 100,000 users trust Right Networks to cloud enable their QuickBooks desktop. Get cloud connected the right way. To learn more, give Right Networks a call at 888-469-5942. And for a special 10% off discount, make sure to mention This Week in Startups before February 28th. And by Walker Corporate Law, a boutique law firm specializing in the representation of entrepreneurs. Visit them at walkercorporatelaw.com.
Charles, just by way of introduction, how many people in the room have a product in market? Who's got their product in market? Who has yet to launch? There she is. One person snuck in. She convinced Jackie to let her in. And then how many people have raised their Series A? Got it. So now you understand the Goldilocks zone that we go after. The products in market, they're not dreamers with an idea and a white paper for their ICO. Yeah. They are actually have products in market. These are legit founders, but they have yet to get the Series A, which is very hard. So this is a really great group. And so Charles doesn't need an introduction. We'll just welcome Charles.
Thanks for having me, Jason. I appreciate it. And it's nice to get a chance to meet a handful of you who I've spoken to on the phone but never met in person. So one of the things we think about a lot at Precursor is I think there's so much focus on getting your round done and raising money and getting over the hump. Sometimes people forget what happens on the other side. And at Precursor, we've invested in almost 90 companies. At my time at SoftTech Uncork, Jeff and I invested in about 150 companies together. So we've seen a pattern across 200 plus companies of what happens to people when they raise money, both going through the process and what happens after. So I want to talk about the part, I think there's tons and tons of blog posts and really good articles out there about how to put your deck together, how to pitch. But I want to talk about what happens after you get the money, because I think this is an area that people don't talk about as much and where you can save yourself a lot of trouble. So a little bit about me. I started Precursor Ventures about 3 years ago. The basic idea was when I was at SoftTech Uncork, we started with a $15 million fund. Our last fund was 100 plus a $50 million growth vehicle. As you can imagine, a $15 million fund has a lot more flexibility in terms of where you invest, how much traction you need to see, check size, than a $100 million fund. At 100, we wanted to see 25 to 50K in MRR for a company that we thought we could get to 200 to 250 in 12 to 24 months, so they'd be Series A ready. At Precursor, almost everyone in this room is farther along than the majority of companies that I meet. The majority of companies I meet are pre-traction, pre-launch, as we say at Precursor, pre-everything. They're just early. And it felt like as the other seed funds got larger, there was this emerging gap for folks who needed 100, 250, 500K, $1 million to go from prototype concept, early version of the product to launch. So started the fund. My original entry into venture was I worked for InQtel, the CIA's venture capital fund, for 4 years. Spent a lot of time on planes going from here to DC. It was a lot of fun. And then I've had more regular jobs too. Worked at Google, ran monetization for a company called Serious Business that built Facebook games that was acquired by Zynga. I've started 2 companies of my own. One had a pretty decent outcome for me personally. The other one, well, my investors still like me, but I didn't give them very much money back. It was a little sad, but I want to talk more about a lot of you have raised money. It's hard. Raise your hand if raising money was easy for you. Just easy, just kind of happened. Well, brave soul, I admit it. Honesty, I like it. For most people, it's really hard. It takes a lot of meeting, a lot of work. It takes you away from your product and your team. It's a real accomplishment. You should absolutely celebrate. Within our portfolio, I would say it typically takes 30 to 50 intros to get an institutional seed round of $2 to $3 million done in our portfolio. Some people get it done in fewer. Occasionally it's more. But you just think, okay, an hour per meeting and an hour of prep, you're looking at hundreds of hours of investment in the fundraising process. So you should absolutely celebrate. And I think what naturally happens for a lot of people is you put so much energy into your fundraising, you get it done, you not only exhale, but you relax, which is the enemy of success. And so I think for a lot of companies, it's easy to think that, we got the seed round done. We won. journey's over. That's not right. It's just one step in your journey. The most important thing you can do after you have your mini celebration is get back to work as quickly as possible. And so I've just been thinking about, like, well, what are the failure patterns that I've seen in companies that we've backed or I've been a part of when it comes to that getting back to work phase after you raise a seed round? I just want to talk to you about these things because I'm sure none of you will do or have done any of the things that I'm going to talk about in this presentation. So I always tell people there's 4 steps that I think of that are part of the important path of getting back on track after you raised your seed round. The biggest one is actually getting back to your product groove. I think when you're a founder, the fundraising process just pulls you out of the day-to-day operations of your company. I tell everyone, fundraising needs to be your number one priority as a founder when you're doing it. Otherwise, it will just drag on forever. And if it's your number one priority, then building the product, taking care of your team, taking care of yourself, probably actually can't be done at the same level as they would if you weren't fundraising. So it's really important to acknowledge that fundraising is really a distraction. For you as a founder, it's going to pull you away. And I have not seen anyone successfully fundraise, with one exception of a person who finished it in 1 week, without it really pulling them away from the operations of the business. It not only interrupts your product groove, it also throws off the whole cadence of your own company. Anyone here had to cancel a one-on-one or a team meeting or a stand-up because you had to do a fundraising pitch? That kind of stuff breaks down your culture in little small ways every time you do it. And fundraising, because you don't control the cadence and schedule, will cause you to do that more often. And I think most people say, "Oh, our product's fine. It's on track." I can assure you, it isn't. The reasons, the root causes, the things that are broken might not become immediately evident, but I can assure you that you're not on track. And so, getting back into product mode is really important. We're going to talk about a couple of examples around this too. And we'll get back to that product one, and I want to talk about team. This is the one, someone asked me earlier, like, how many companies have failure patterns? I'd say almost every company that I've been a part of does at least one of these things post-seed round. So if you see yourself saying, "Oh, we did that," you're in good company. This is the one, though, I feel like people are really uncomfortable doing in general because it involves conflict. After you close your seed round, I do think it's really important to look around the table and say, do we have all of the people that we need for the next phase of our journey? And that can take 2 dimensions. One, do we have the right people in the right seats? Are the people we have on our team ready to level up and do the next bit of work? And do we have glaring holes that now that we have money, we need to feed? We need to fill those holes. It's almost inevitable that if you got to the seed round stage, you have some really strong performers in your team, but you probably also have some gaps. There are almost certainly a few places where you need, and most typically in B2B companies, strong on engineering, weak on marketing at the seed stage. Consumer company, maybe you're strong on product and maybe a little bit light on engineering. Everyone has gaps. That's normal. But it's really important to be honest with yourself and your management team about whether you have the right people. And so I'll give you a real world example. This is from a company that raised a Series A that I've been involved with for a real long time. They just raised a pretty large Series A from a big institutional VC firm, and they sent me the board deck that their finance person had prepared, and I looked at it and I said, this is like trash. Like, the numbers actually don't add up. This is not the format I wanted. This feels like not Series A leveled up quality of work from the finance team. So I called the CEO back and said, hey, I would not share this deck with the rest of your board members. This is not you putting your best foot forward. And I said, why did it take so long to get it? Well, it took a long time for our finance person to actually pull the numbers together. I just said, oh, well, you have a problem in finance. And he's like, well, it's really hard. He's been with us since the beginning. He believed in us. I said, I'm not saying that he wasn't absolutely instrumental in getting you and the company to where you are today. I'm telling you, you do not have a person who's capable, based on what you sent me, of helping you get to the next level. And you have 2 options. You can either address this very quickly on your own and get in front of it, or your board members are going to ask you to address it, and it's going to look like you're behind the curve. Which of the 2 is it? So this founder decided, out of loyalty, which I admire, to stick with this finance person. That finance person is no longer at the company. That CEO is no longer at the company. And the reason that CEO is not at the company, the board had a hard conversation with him and said, part of your job is to do uncomfortable, difficult things in a humane way. And protecting this finance person who was not capable of doing the work wasn't actually doing a service to that individual, definitely wasn't doing a service to the company, and wasn't doing a service to yourself as the CEO. And so the inability to recognize that we had the wrong person in that role cost that CEO his job, and it cost that finance person the opportunity to leave on much better terms and to go find an opportunity that was probably more appropriate for his skills. And that happens all the time. The other failure pattern I've seen that works like this is many times the CEO and founder is wearing many hats. And oftentimes I have this conversation, well, who runs product? Well, we don't really need anyone to run product because like I've got a bunch of good ideas and like I like spending time with the engineers, and like to date, me giving the engineers general guidance around what to build has worked great. Well, I'm like, okay, you've got like 6 or 8 people in the company. I can see how that works. What happens when you have 20 people? And what happens sometimes as CEO and founder, whatever that superpower you have as an individual contributor, it can be really hard to acknowledge that you doing that role 50% of the time is not as good as having a really good, talented person in there doing it 100% of the time. And sometimes the problem is that the person who's not around the table isn't there because you as a founder have to let go of some function or skill that you really prize.
Yes, Right Networks. Thank you for helping entrepreneurs move their accounting-based desktop applications like QuickBooks Desktop or your Microsoft Office right to the cloud. That's right. Right Networks will get you right to the cloud. So there's no more worrying about servers and backups and storage. No, you can work from anywhere and enjoy that added security of knowing all your finances are backed up properly. And you can get rid of that crazy IT burden and have more time to focus on your business. You can keep track of those finances and operations easier than ever before. That's why 100,000 users trust Right Networks to cloud enable their QuickBooks Desktop. It's proven technology with exceptional support and a commitment to helping customers 24 hours a day, 7 days a week, 365 days a year. Support based right here in the US of A. So get cloud connected the right way with Right Networks. And here's your call to action. This is the important part. To learn more, give Right Networks a call at 888-469-5942. That number again, 888-469-5942. 469-5942. And you will get a special 10% off discount if you mention This Week in Startups. But you got to do that before February 28th, okay? 2018. Go ahead and give Right Networks a call, 888-469-5942 for that 10% off. Use the discount code This Week in Startups. Okay, let's get back to this amazing episode.
Okay, so we'll talk about this one. Get to know your new investors. I think during the fundraising process, you get to know people, but it's a little bit arm's length. The VC is evaluating you, so you want to put your best foot forward. You're evaluating them, so they're trying to put their best foot forward. That's actually not a dynamic that's particularly conducive to people actually getting to know each other. And you might have built up a really good rhythm with your existing investors. Oh, you know, every Friday we hop on the phone and we do a big debrief, or I send out an update every time and like it's fine. Your new investor just might be a different person. He or she might have different communication norms, might have a different style, might have different expectations, might be used to something different. And this is particularly an issue when you go from seed to Series A and Series A to Series B. Because I think everything up to Series A is relatively, I would say, collegial, collaborative, and kind of informal to some degree. Once you get to Series A and Series B, it becomes a lot more structured. I think the expectations around what those investors want to see from you as a management team in terms of reporting, insight, advice, they come to the table with a set of expectations. They might not share them with you if you don't ask. And you might get 1, 2, 3 board cycles in, and they feel like, gosh, I just don't get enough communication from the CEO. And your old investors will be like, what are you talking about? It's great. They send their monthly update. This is a real world example that happened to me actually this week. I have a company that raised a Series B. The Series B investor called me and said, the CEO, she communicates too much. I said, what do you mean? She goes, she sends a daily email and it's like 100 words. How do you deal with this? I'm just like, oh yeah, I know. I found it kind of jarring in the beginning, but like, it's a nice rhythm. I feel like I always know what's going on. And he's like, do you read them all? I said, of course I read them all. It takes literally a couple minutes. It's an email. I know that it's coming every day. So I look out for it. It comes first thing in the morning. And he's like, do you respond to all of them? I was like, oh, of course not. Like, this is not designed to kick off a daily email thread. This is a way for this CEO to share this information with us. And it gives us a sense of, today, these are the top of mind issues. And he's like, this is too much for me. And I'm afraid that I'm missing something. And I'm afraid that if I don't read these every day, he's like, I'm not used to this. There's got to be a different way. So I called the CEO and said, hey, I just had a chat with your newest investor. He admires your communication style. And it worked great for us as seed investors and Series A investors. This person, though, wants you to do something different. And maybe he's onto something. Maybe you've gotten to the point where once a day is too much. So you should think about it. I said, I don't care. You can keep daily for me. It's totally fine. And she switched to weekly. And it's kind of the same length email. And now when she has kind of more something she wants to talk about, we have basically a group chat, and she'll just go in the group chat and say, hey, I want to talk about this. If any of you guys have time, I'd love to bounce. And there's no pressure for anyone to jump in. And it works great. And she adjusted her communication style. And I think this new investor flagged the thing that the company had grown up. There was no need for a daily email anymore. And I think without someone prodding her to do that, probably wouldn't have happened. And the other thing is that, I think very few investors are good at everything. Some people are really good at fundraising. Some people are good at strategy. Some people are good at ops. Some people are good at hiring. What's incumbent upon you as an entrepreneur to get the most out of your investors is you've got to spend time with the new people to figure out what they do well. And I think what happens, and I see this happen all the time as a seed investor, I've usually been there the longest. So I've known the CEO, I've known him or her up and down, and it's very easy to go back to the people where you have the most comfort. And oftentimes the people where you have the most comfort as an entrepreneur are the people who've been with you for the longest through thick and thin. But sometimes you reach issues where I, as a seed investor, I have no perspective. If you're like, hey, we're thinking about raising this huge debt line, I'm like, well, this is not an area that I spend a lot of time thinking about. This is something you should really take to your Series A investor. And so I've seen it happen where people try to drop new investors into an existing rhythm and workflow that work great for the other people without giving that person a chance to weigh in and provide perspective. And I think it's a lost opportunity. So one other thing I'll tell you, I have a founder who's probably one of the most self-aware people I've worked with, and she writes a user manual that she shares with every investor in the company. And it's 5 pages. It's her background, how she grew up, how the way that she grew up influences the way that she thinks about the world, how she makes decisions, her own explanation of her own idiosyncrasies and kind of personality quirks, personal interests, family situation, how she makes decisions, how she likes to communicate. It's super useful. It's so useful, in fact, that I've written one for our portfolio companies that I now send to them on how to work with Precursor. And I just think that was a really great hack that she came up with, because as a new investor, you can come into your first meeting with her with a lot of background on her that you might not get to for years. So think a lot about how you're going to onboard your new investors. This one is probably when the air goes out of the room after a seed round. Whenever we have the first meeting after the round's closed, everyone's like, we're closed. I'm like, okay, cool, let's talk about the Series A. And everyone says, what do you mean? We just closed our seed round. I don't want to talk about the Series A. We just finished going through this whole process of hitting these milestones and getting there. There is no better time to think about your Series A milestones than the day you close your seed round, because time has a really funny way of sneaking up on you. And the sooner you put pen to paper and say, now that we have money, and now that we have resources, and we've signed up to grow, what does good growth look like? And I think the point of money is to help you grow and help you answer questions. So I'll give you a real-world example from last week. I met with the founder who had raised kind of more like a pre-seed round. He's growing, good business, generating a couple $1,000s a month in revenue, low churn, decent growth. He came to me and said, I have this vision of raising this large round to like scale up our company. I want to raise, and I won't tell you the specific prices, but it's $3 million and a pretty high valuation. He said, what do you think? I said, I don't think you're on track for that at all, in like in any way, shape, or form. And I mean that in like the nicest, loving way possible. Because to get the round that you just told me you want, by the end of the year, you need to be at like 12x your current revenue run rate, growing 20 to 25% a month with low single-digit churn. And he's like, oh. I'm like, but good news is you have 10 months to get there. But like, that's where you need to end up. So we have to be honest. Can you actually put together a plan that you believe in that working backwards gets you to those milestones? And if you'd waited till June to say that, I'd be like, well, it's too late. Half the year's over. You have 1 quarter to get the numbers you need. They need a quarter to fundraise. And the reason the Series A milestone planning is so important is it forces you to work backwards. If you say, hey, we want to raise a series, we have 18 to 24 months of runway, which means we're probably going to go fundraise in 12 to 18 months. On our current trajectory and based on what we know, what is the business going to look like if we do nothing different? You should always ask that. This is like the first thing I ask people every time I see them. And Amado, you'll learn this really soon, is that if you don't do anything different, you should always say, like, where are we going to end up when we need to fundraise? And is that an interesting company? And I'm shocked the number of times I talk to founders and say, if we don't change anything, where are we going to end up? How do you feel about that? And they go, that doesn't feel good. So the status quo is insufficient. We have to find a lever or a way to increase or change something about the growth rate or characteristics of the business to make it more attractive. And the sooner you start working backwards, it'll also tell you when you're not on schedule. You might realize, hey, in order to get to this really lofty end of year exit ARR, we kind of need to be on track 6 months beforehand. So that means, okay, we can put a pin in the calendar and we know 6 months before, we just check in and see where are we. And so I think this is like a really uncomfortable thing for people to do because it's natural to be exhausted by fundraising because it takes a lot of energy. But you immediately have to get your mind into like, that is the past. Like we have the money, we have the resources. How do we put the company on a growth trajectory that will be interesting to investors? So I want to challenge you all to think about some things. These are the questions I always ask companies I back after they raise. This one is a big one. Now that you have money, are you going to hire the same kind of people? I think for most companies, when you're at the seed stage, I think there's this spectrum between true believers and we'll call them, more mercenary-oriented people. I think in the beginning of your startup, you have no money, no product, no evidence. You kind of need to grab all the true believers you can find, people who are like, I believe in this problem, I believe in you as a founder, I will work for you. It's probably irrational. They're probably making way less money than they could. They're probably working too many hours. But like you need to optimize for like belief up front. And if you are a pre-seed, pre-launch company and your friend works at Google and you call her and say, do you want to join my startup? She's probably going to say no. When you have money and traction and evidence, it changes who finds your company attractive. And you will suddenly find people who wouldn't have responded to your LinkedIn message or your job posting suddenly are interested and curious about your company. And you have to be very careful about how you think about your hiring philosophy, because having money and resources will change the top of the funnel. And do you want to actually look for different stuff? Do you want to become less true believer, more this person's been there, done that, and can be additive to the culture? Like, of the things that you're screening for, which of them really, really matter, and which of them are an artifact of the fact that you just had no money? And what I find is that if people aren't explicit about this conversation, you just end up hiring people that you look back and go, well, why did we hire that person? Well, they were more qualified than the people we'd been seeing before, and it was flattering to know that someone from that big company thought our startup was interesting. And you can easily lose your way because you didn't stop and say, let's be explicit about what we're looking for and how money is going to change. Are you going to suddenly start paying people market salaries? This is another big one. Oftentimes, to get to that seed round, people sacrificed. And at some companies, taking a pay cut and financial sacrifice is like a cultural value. Like we want people to do that as part of our culture for a lot of reasons. And sometimes people relax that. They say, now that we have money, we should win on cash. or we should win on equity, or we should change our thoughts and conversations. So don't fall into the trap of making decisions without a plan. So the other thing that happens is you end up doing all this planning. You go, gosh, we need a marketing department. We need a CTO. We need a VP of engineering. We need all these people. Let's go get them all right now. It is really difficult to do that. And I think it's the natural intention, because you've probably been operating in a really resource-constrained environment for a long time. And now you have resources, and the natural tendency is, I want to go hire everybody. I want to fill in all the gaps. Don't do that. It's really hard for you as a management team. I tell people it's really hard to digest large numbers of people when you're a very small company, because every person you hire, so on a percentage basis, is a huge introduction of newness to your organization. And so resist the urge to go fill out your entire hiring plan for the year, the quarter after you fundraise. And so I worked with a company that decided that they were tired of being 15 people, and they decided to hire 15 more people in 2 quarters. Very, very quick, basically almost a person every other week. Only to learn about midway through the second quarter that they'd made a huge mistake in an engineering director. Which in and of itself is fine, but that engineering director had hired 6 engineers, none of whom were really up to the cultural or quality standards the company is looking for. But because it hired so many people at once, they got all of the information around performance back to these people at the very same time. And had they staggered that hiring, it's easier to keep tabs on a handful of new people, their performance, their fit, their ability to contribute, than it is to do it with the whole thing. And when you have 6 new people in the engineering department, engineering is dysfunctional, you're like, is it all 6 of them? Is it one person? Is it the fact that they're all new? And never disambiguating the root cause of the problem becomes really, really difficult.
Yes, the Walker Corporate Law Group. Scott Walker has been a friend of the show since the beginning, and he is, in fact, the longest-running continuous partner of This Week in Startups. And the Walker Corporate Law Group is a boutique law firm specializing in supporting startups and their founders, and they encouraged fixed fees. What is a fixed fee? They tell you what it's going to cost to accomplish the tasks that you need to get done. Whether that's mergers and acquisitions, or starting your company, or licensing agreements, your terms of service, privacy policies, all their lawyers have decades of experience, and they're not junior associates learning the job and the craft of being a great lawyer on the job with your startup. They're not experimenting on your startup with their legal. These are serious lawyers who know what they're doing, and they charge a fixed fee because we all know billable hours reward inefficiency. So if you want to talk to the founder himself, Scott Ed Walker, you can call him directly, 415-979-9998, 415-979-9998. Or you can email Scott at walkercorporatelaw.com, Scott at walkercorporatelaw.com. Put Jason in the subject line. Jason sent me. Okay? walkercorporatelaw.com, 415-979-9998. Thanks again, Scott Walker, for supporting independent media like This Week in Startups for, I think, 7 or 8 years you've been with us. I really appreciate that, Scott. And it's great to have built this little podcast with your support to support entrepreneurs, because I know that's what you love to do as an attorney. Okay, let's get back to this amazing episode.
Here's the other thing that happens when you get money and become more high profile. Like, the distraction function for you as a founder goes way up. You will suddenly get invited to give talks, to go to conferences, to hang out with other founders. Your VCs will impose upon you to mentor other people in the portfolio and tell them how you got your Series A round done and why you're so magical. You will get pulled in many other directions. And it's a fine line. It's good to network. It's good to go to things. But you got to ask yourself, is this really good for my startup? Or is this good for me and my personal brand, separate from the startup? And look, I'll be honest, it's okay. I have founders that I've backed who do things that they go to events and conferences that I would not go to because I think the business value of them is limited. But it's important to them, and there's this is not about the company, this is about something that's meaningful to me. No judgment in small doses. But it's very flattering, I think, as a person when you've been like the anonymous startup that no one's heard of, and suddenly you're getting invited to fly to Helsinki and give a talk to the Helsinki startup community about how great your mobile database company is. But that could be a day of travel each way. It could take you a week to get, and they're like, oh, we'll pay for it. That's actually not the issue. The issue is focus and time. And you'll be away from your company for 5 days to give a talk that I'm sure is interesting, but like, does it really matter in the context of what you're doing? And so what I see happen to a lot of founders is this wild swing. Oh, we're getting all these speaking invitations. I'm doing everything. And the company's hiring. Now I'm doing nothing. Oh, doing nothing feels bad. Now just try to like get out of this huge pendulum swing. Give yourself a budget of like, hey, I'm willing to spend an hour a week mentoring people that I don't know on stuff that I think I can be helpful. Just come up with a plan for yourself. Because what happens, you'll get a Series A and other friends like, I'm struggling with my seed round. Can you look at my deck or can you make some intros? And it feels good to help people, and I spend a lot of my day helping people, but I try to be thoughtful about, like, every hour I spend helping a person I don't know potentially comes at the expense of supporting a portfolio company where I've made a financial and emotional commitment to support that person. So I personally, at Precursor, I have a budget for cold pitches of people I do not know that are well-written. And it's like a couple of them a week. It's not it could easily fill every day, but I'm like, that's not the right balance. So I would encourage you as a founder, just be ready that when you announce your big round of financing in the press, you're going to get hit up by lawyers, other VC funds, real estate people, HR people, everyone. You're going to be inundated, and it's going to feel good because it's been so hard before. Just be mindful of that. And this is the one, only you can answer this. I can't answer this as an investor. Part of fundraising is selling. I get it as an investor. I really hope that no one would ever give me a plan that they don't really believe in, but it does happen sometimes. Once we're on the same team, that's all over. The only question is, what's the real plan that we all agree to and believe in? And so if you pitched me 25% month-over-month compound growth for the next 24 months, and we get into it 2 months in, and you're like, we don't know how to grow faster than 10 to 12% a month, we'd have that conversation. You should really pitch the truth, and you should pitch a plan that you believe in. But if at any point shortly after the fundraising, you want to have an honest conversation about like what you think is likely to happen that could be different from the plan, do that sooner. Investors know. We know, like, you're painting the best rosy picture of what you think will happen, even if you call it the conservative case. Like, we know what that means. And that's okay. But like, once the investor's on your team, it's really important that you do what you can to get to a place of truth and honesty with them. And I think the plan is where the rubber meets the road, because having a plan you believe in dictates hiring, dictates how we think about the growth rate that makes sense for the company, dictates who we think about for the next financing. And it means we can get ahead of problems. And I've certainly seen people fall in love with the plan that they use to fundraise, even when the data from the real world is telling us that that's not the case. We kind of covered that one. This is another one I would just encourage you to think about as founders. At every stage of your development, you will probably need a new set of mentors for specific areas. It's always, in my opinion, good advice to have people around who just know you and understand how you process information. But you also want to have new investors who can help you get to the next level. So if you've never done a big strategic partnership with a public company, go find an advisor who has. And you might not have that person, and you will outgrow some of the people who helped you get here, and that's natural. Doesn't mean you have to totally cut them off, but the advice they have to give you just might not be as relevant anymore. All right, I'm going to tell you a couple specifics here. Just do not forget that the reason that your startup has been successful and that you've gotten to where you are is because of your judgment as a founder and the decisions that you've made. Do not fall into the trap of becoming over-advised, over-consulted, over-mentored. So I have a company that I invested in, I've been an investor in now for 7 years, and this company's raised quite a bit of money, but twice they basically couldn't fundraise. And they have a really particular, I don't want to say too much about what company it is, but they have a very particular business model that is not intuitive to most people on first glance. And they went out to raise their last round of financing, and sort of the consensus from a bunch of the investors they talked to said, if you change the business model to be something more conventional that we understand, maybe we'll get there. But as is, it's just too hard for us to wrap our head around this business model because we've never seen anybody succeed this way. So the founder came to me and said, look, the market's telling me I've got the wrong business model. I was like, well, your balance sheet is telling me that it works pretty well. Like, I look at the business performance and it works really well. Like, what is it about these conversations that's giving you pause? He said, well, this person's from a really famous Sand Hill Road Series A VC firm that's been associated with a lot of IPOs. This person is on the Forbes Midas list of like most successful VCs. They're all telling me I need to make this really important change in my business. I'm like, well, they don't actually know your business. They're telling you what they think will work. The reason we've gotten as far as we have is because like you've made the right call, and even I've disagreed. Twice the founder told me he was going to do something that's kind of an enterprise business model that I was like, you don't have the money or team to pull that off. It will not work. And he was right both times, and I was completely wrong. And he had the guts to just say, hey, I'm here every day. I'm in the building. I know what works. You're not. And somehow getting close to Series B caused him to have self-doubt and say like, hey, the people I'm talking to are telling me what I'm doing won't work at the next scale. I'm like, well, it's worked fine here, and you know your business better than they do. So I think at Series, as you get farther along, there are more people who want to speak in your ear and give you advice and feedback. And I think it's incumbent upon you to always remember, you know more about your business than just about anybody else. And so don't fall into the trap of getting over-advised. So that's all I had for you all. I thought I'd leave some time for questions and talk about other failure patterns or things I've seen come up with companies. Thanks.
That was very strong. I was taking some notes.
Folks line up for questions?
So folks can line up for questions. I'm curious, we had a bunch of questions in the morning that we were going to get to. The first one I don't understand completely about having no revenue, so I'm going to reinterpret it. It says consumer mobile usage metrics without revenue. What's your advice for consumer companies that are pre-revenue and in the seed stage and trying to get a Series A? How should they approach it?
I think it depends on the kind of business you're building. So if you're building an advertising audience-based business, like a Twitter, we'll just say, where you need a lot of people to make the advertising model work, it's okay to have no revenue, but you can't have no revenue and slow growth. So if you say, hey, look, we're doubling every week, we need to get to some minimum audience size to make the advertising model work, and everything says that you're going that direction, you might find someone who could buy that story. If you're growing 2% a month and you're like, we need to get to an audience of 100,000 people, people would say you just don't have a good product or business. But if you're doing a marketplace model or a transactional service, people expect to see transactions.
Why do you think so few founders will turn on revenue in the beginning? We see a lot of people giving pilots. They tell people like us, oh, I've got 12 customers. You say, oh, how much the customer's paying? You say 0. You say, well, they're not customers and they're users, so when do you plan on charging? What is the psychology behind it, and how do you mentor people, advise people who have that fear or aversion to charging customers? Where do you stand on that?
I think you said the word I was going to say, which is fear. I think a lot of times what happens is people believe in their product, but if they've never sold or if they're nervous, like, what if I ask for $10,000 and they say no? I'm like, well, it's a negotiation. They said no to $10,000, they might pay you $8,000. But I tell founders all the time, like, most businesses hinge on one or two really critical assumptions. And if your business model or willingness of customers to pay is one of them, you should get out in front of that as early as you can. So look, if you have a B2B SaaS company, you should be charging. Your customers expect to pay for software. Like, they don't get Salesforce for free. So whenever someone tells me they're not willing to charge, like Jason said, I want to plumb and say, what is it that's holding you back? Is it you're not as confident in your product as I thought you were? You're afraid to ask for the order, or you're afraid to ask for the order at the price that you think makes sense? And a lot of times it turns out people have never done it. They've never gone to a customer and say, I want you to pay me $10,000 a year for this product, and you should do so happily.
Okay, let's take a question from the audience, and I'm going to ask for crisp, tight questions, not plugs. Go.
Hi, I'm Karen. I have a question. As I'm starting to build the relationship with investors and advisors to get to raising my seed round, what should be included in my updates?
Great question.
Wow, that's a good question. I'd say most of the good. So I get a lot of updates from companies where I'm not an investor. The ones that I pay the most attention to kind of have the same format. Here's the high-level metrics or things you need to know to understand whether we're growing or not. And it can be whatever the KPIs are, revenue, usage, users, whatever it might be. A little bit of a narrative about what they've learned. And usually there's an ask of some sort. And what I would say is normally people who've like reeled me in, like I'll read the updates and I'm like, oh, this person wants an introduction to Dropbox. Oh, I know someone at Dropbox. Like I'm happy to help there. And most of the companies I've invested in, it's like I started helping them before I was an investor and they kind of reeled me into working with them on problems or issues. And I was attracted to the person and the problem and thought it was interesting. And next thing I know, I wrote him a check. So I think a good update will create that loop.
Great. Next question. Again, no pitching. Questions, please.
Hi, I'm Swati. Thank you for your time. This particular Founder.University is for underrepresented founders. So I'm just curious, and we haven't really talked about it directly. What do you see any differences or anything in particular that an underrepresented founder would have to be more mindful of given the fact they're underrepresented? So.
Great question.
Wow, I almost don't know how to answer that question. It's a tough one. So I think what you don't want to do is psych yourself out before the meeting ever starts and just say, because I'm a woman, because I'm a person of color, there's no way the person across the table is going to identify with me. Like, don't put yourself on defense before the pitch even starts. And I do see that happen sometimes. People come in so aware of their differences that they undermine their own pitch. I would say this, you should do the same things that other people do. You should use your network to the extent you can to create momentum around your round, to get back channel feedback on investors. And I think that I do think the big challenge is like, don't get too in your own head about it. And if you do pick up on the fact that an investor just does not get you or does not get your market, the odds of you convincing them are pretty low. So I would just say, hey, this is probably just not a great fit. And you're probably more likely to have that happen than someone who's not a person of color or woman.
Okay, thank you.
Okay, great question, great answer. Okay, let's take another question.
Well, it's good to meet you in person, Charles. Yeah. But so earlier during the talk, you mentioned pre-seed. If you hadn't said that, then I want to have this question. But what's the real difference between pre-seed and seed? And if usually I hear 12 to 18 months of runway. But then if you're supposed to start looking for a Series A right after, that's a long time, right? So, what's the real advice regarding how soon you want to get back to that if you really have a year and a half of runway?
Yeah, so everyone has a different definition for pre-seed. I think of it as, it's the old seed round. It's $1 million or less for companies that are what I call data light. You don't have much evidence that what you're doing is working. Just to give you some perspective, the last 3 seed rounds that were done in our portfolio, one company was at $55,000 a month in MRR to raise $3 million. One was at 22, and one was below 10, but was growing almost vertically. So I just think the problem is like the seed funds have gotten so large that they want to write checks of 1 to 1.5, and so they expect to see real evidence of progress. So my rule of thumb for the companies in our portfolio is, you're in the zone if you can get to 100K in ARR. If you're a SaaS company, most people can't bootstrap their way to $100,000 a year in revenue because you need to hire people, you need to build tech. And so pre-seed's the plug that can hopefully get you from 0 to 10, 12K in ARR and get you in the zone of being an attractive seed company.
Okay, and then runway.
Yeah, so we really believe at Precursor a year is the right amount if you're at 0 data, because you should be really laser focused on getting the product out, getting evidence, traction, metrics, and proof. And I think a year is perfect for that, because if you can't get it done in a year, my guess is another 6 months wouldn't make a difference. For seed rounds, it's 18 or 24 months is what you're really going to end up getting in terms of burn. which means you're going to get kind of a year to operate, and then you're going to get 6 months to plan, and then you're going to fundraise.
Okay, great answer. Take another question from the audience.
Hi, Charles. I'm Vivian. Not plugging, just providing context.
Okay.
Our company makes smart pets for VR, AR, and I feel like we're in an interesting situation where we're more of an entertainment company rather than providing a solution to a problem. And that's made pitching interesting because I feel like the problem-solution dynamic is how most investors frame, and they need that framework to see the market size. So that got us past pre-seed okay, but going into seed and eventually Series A, how would you advise a company like ours frame the opportunity without a real problem that we're trying to solve?
So I think media, entertainment, and consumer companies are very hard for most VCs to understand because it actually means you have to have a sense of taste. You have to have a sense of like what will actually resonate with the consumer, and it's why most VCs don't do movies. We don't do music. These are like cultural taste questions, and if you don't trust your own instincts on culture and taste, you won't do much in e-com, media, or any of the sectors you're in. So for you, I think it's more important to narrow your list of target investors to people that have a track record of betting on consumer brands or products or meaningful consumer trends and who understand what companies at your stage look like. Now, the flip side of that means you'll probably end up with a pretty tight, small list.
Yeah.
And it means you're probably going to have to invest more in going deeper with a small set of people as opposed to pitching a ton of people.
Got it.
In addition, I'll just add that you've added to the degree of difficulty by going into an unknown, unproven technological platform. So you've now added 2 layers of risk. One is, will VR or AR ever take off? And there's a huge debate about that. And it's been DOA, hype, DOA, like literally every time. And so now you've got to convince them. I think Charles's advice is really good, which is if you're pitching somebody you have to convince on consumer or VR, AR, this might be climbing 3 mountains back to back. Just not possible, or climbing it backwards on one leg. It's just not possible. Too difficult, too high. But I will give you a little hack, which is when you have all your metrics, just get rid of the 90% of people who are not the top 10% of users and focus it on those top 10% of users. Because in an emerging technology, what 90% of people do at Snapchat is not indicative of Snapchat's future. What the 10% who are addicted to it and open it up every day, they might be, if it does catch on, it'll look like that. So for example, Twitter, when people started it was supposed to be like, what's going on? And you were going to answer that every day. And then Robert Scoble, myself, and the Senator Obama guy were on it, like using it as a chat room. And people were like, it's not a chat room. Stop having conversations. You're not using Twitter correctly. And that was, you remember this?
I remember these days.
Yeah, and people were like, do not reply back every time. You're replying back too much. And then they put replies on a second tab to deal with Scoble and myself and Obama, who just felt like they needed to reply to people. And that is, and now you look, it's a cacophony of madness, and we won. So with yours, who are those top 10% who just are playing Pokemon Go for 20 sessions a day while driving? Like let's get those idiots and videotape them and do a listening lab with them and say, I know this sounds crazy, but watch this video where we did a listening lab. So we actually did that at Mahalo when we were showing a search result that had sections and images and videos and news blended between the 10 blue links. Because nobody believed me when I said, no, people want more than just 10 blue links. They're like, no, they don't. They want 10 blue links because it's efficient. The second you put images and content on that page, it gets confusing. That's on the second page. And I was like, nah, I think content will be on the top level between the links. Of course, we were right, but we got our asses kicked anyway. Okay, great question.
Great, thank you.
All right, let's take another question.
Thank you so much for coming. So you talked a little bit about the energy and time it takes to start your seed round, and I'm approaching that now. So I'm the COO, and my co-founder is the CEO, and I think we have very strict I guess, roles in terms of the differences. So he's very much focused on student acquisition, and I'm focused on student activation. But I know that I'm the stronger presenter, and I know my shit when it comes to Q&A and things like that. So I'm wondering if I should be the one focusing on the seed round as we're kind of moving towards like pitching more enterprise, and as well as like the student acquisition and student activation.
So here's a hack for you. The founder comes up and says, hey, I'm Jason. I'm the CEO. This is Kayla, who runs sales and marketing and product for me, with me. And here's the mission of the company. Here's where we're at in terms of fundraising and what our ask is for today. I'm going to hand it over to Kayla, and she's going to go over the product. And then Charles is going to go over the sales process, and then I'll circle back around with any questions. So, Kayla, you have the floor. And then you're like, okay, that's dope. This person knows how to like manage a team, and they're giving props to their best players. You know, it's like when LeBron passes the ball, when it's like, but why doesn't he just dunk every time? It's like, yeah, he wants to keep the other people awake. You know, like,
Got it.
I mean, it's a big complaint about him. It's like Westbrook and Harden are just like, no, I'll put the ball in the basket. And it's like, you want to pass it? No. I want to score 50.
I think that's really good advice, particularly if you're both in the room at the same time.
Also keeps your other teammates feeling special and wanted and engaged. I always would bring in my CTO at board meetings and be like, yeah, we're going to Sequoia and you're going to present this time, or a salesperson's going to present this time. You see that too, right?
Yeah, I do see that.
Yeah, it's nice. And they come in for 10 minutes and then they leave. Okay. Question?
Hi, Jahan Thompson. Thank you so much for the presentation. My question was around when you mentioned the founder that was sending you daily updates, and I'm curious for your seed founders, what's the best way for them to be engaging with you? And I think as I'm thinking about raising my seed now, I have some mystery around how much do you engage with the investors in your round? What's the best way to use them? And would love to kind of see what's worked with seed founders that you worked with.
I'll be honest, one of our top performing companies never sends updates. So I used to think that there was like a strong correlation. I now think there's a strong correlation between change in behavior. So if you're going to start sending updates, don't stop, because I don't know about you, Jason. I've never had a company that's doing so well that they stop sending updates if they used to send updates before. So what I tell people is like, I'm able to, I'll give you just a variety. We have one portfolio company where the CEO writes a color-coded update where things that are going well are in green, things that are going well are in yellow, things that are going poorly are in red. And so you can visually just scan it when it comes in your inbox and like, oh, there's a lot of red. There's like problems here. And like that's the way that she organizes her thoughts. I have another founder who writes something that's more like a letter once a quarter. That it's more narrative, and they give a data pack that's just like, if you want the numbers, here's the numbers in a spreadsheet. But if you want a narrative about what went well and what we learned, like you can read this thing. Other people just have the simple bullet point, cash on hand. The things that I think are always good to tell your investors: cash on hand, burn, head count. If there's something really big going on, like flag it.
Lawsuit.
Lawsuit.
Yeah. And we're being sued by a patent troll.
Yeah.
Right. Just good to know. Yep. This is when we're racing our next round.
That's right. And I have a few founders who they'll send an update and like we'll text. I have others where we have a quarterly standing meeting and we talk about whatever it is that we're going to talk about. But I think it's sort of up to you as the founder to decide this is the cadence I want to set and this is the level of information I want to share.
And here's the most important thing. Sending nothing is the problem.
Yeah.
Sending something puts you in the category of people who are diligent and who at least respect the people who gave them money enough to keep them informed of their investment. And we just dealt with an industry where it was like, don't send updates, don't give data, take information rights away from investors. It was a brief period. It was dark and weird. But we were able to sort of stand up and say, listen, the reason investors need information and want updates is
to be helpful.
To be helpful. That's the beginning and end of it. We're not coming to your office over your shoulder micromanaging. Once a month, a 5-paragraph, 2-chart update. If you can't write that, it actually tells us, to your point about the finance person, you don't even know what the controls are. You don't know your altitude and the speed of your plane. If you don't know the altitude and speed of your plane, this thing might be going down and you don't know it. And that's what the problem with that. When you told that story about the accountant and the CEO, that's like the co-pilot being like, pilot's like, hey, what's our speed? And the co-pilot's like, yeah, I think it's this. No, it's this. You sure it's that? Yeah, no, I'm not sure. And it's like, well, he's a nice guy and he didn't get the speed of the plane right, but he's been with me since the beginning of the flight. It's like, what?
Yeah.
This person should be a flight attendant. Or baggage handlers. All right, there's another job for them.
There's a role for that person on the plane.
There's a role on the ground.
Yep.
Holding those two things where at security. There's a Starbucks in the
That's right.
terminal. All right, good.
Thank you.
Yeah.
Okay, lightning round. 3, 2,
great.
go.
Hey, thanks, Chooks. I'm Chooks, CTO of Pilsy, co-founder. I believe you met Jeff, my co-founder. Yeah, great. So we're at the point. I like what you talked about.
Question.
Building a team. We're at the point right now where we're building a team.
Yeah.
So, what advice do you give your companies as to how much we rely on investors' input as we scale out our team?
Okay,
for high
great
level?
question.
Yeah.
You can answer.
So my basic policy at Precursor is that I will help you close, but I won't help you source. I think sourcing is actually, if I know someone in my network, I'll help you. But like honestly, you have to learn how to entice people to join your company, and you have a better sense for your values than I do. What I can tell you is I interview probably 200 people a year, and what I like when founders go. 2 things. 1, we're looking at this person as a chief marketing officer. I've already met with them. I want to know, what are your instincts on brand? So give me some guidance as to like what to explore. And then I'll come back and say, this person was incredible. This is like one of the top 5 CMO candidates I've interviewed all year. Or this person is very, very average.
That's helpful. It's really weird when they're like, do you know a CTO? And you're like, yes, I know a lot of CTOs, but that's not my job to go find you a CTO. Okay, next lightning round, go.
Julie Novak, Party Slate, Chicago. Quick question. I've heard different things about using analog companies that are similar, like We Are the House for the luxury events world. Do you like those comparisons or only if needed?
The problem is you have to make sure that you understand both X and Y.
Yes.
And sometimes people will say, I'm sure, Jason, you get this all the time with your Uber relationship. We're like Uber for X. I'm like, well, do you actually understand how Uber actually works? Like, your analogy doesn't hold, because the challenge with these models is I then start thinking about, like, well, how does Uber work? And is this really a good parallel? I think it's good to have a really short, pithy way to talk about what your company does. But I think the challenge is if you pick a company either that you don't understand or isn't well understood, you can get dragged in directions that you don't want to go.
Yeah, and another pro tip, know the investor's portfolio. And if you say, we're building this product because Pinterest sucks. Now, Charles, we know that you're an investor in Pinterest. And Jason, we know you passed on Pinterest and you've kicked yourself ever since. But Pinterest really sucks. And the 90 million people using it every month are dipshits. And here's why. Because they don't allow AR objects. There's no augmented reality. Fuck it. It's terrible. And you're like, but Charles, that's his big unicorn. He's returned 3 times his fund, and I want to kill myself over it. And I'm sure there's somebody there who did an AR pilot for the CEO, and he said too soon.
Yep.
Right? It's like, be careful disparaging. It makes you look weird and petty.
Or claiming to know more about the strategy of a company where I'm in. And this happens to be like, well, we know they would never do that. I'm like, they're actually working on that.
That's a great one. No, I've had that many times. Like, yeah, no, Uber's never going to get food right. And I'm like, yep, you're going to try to be Travis. I wish you luck. Chad, you get the last tight question. Go.
Cool beans. I've heard that investors are trying to really find out like the 5 different risks associated with a company. At the pre-seed level, what is the one risk that you always will pass on if it's not been addressed? Or the opposite, what are the ones that you absolutely need to invest?
I would say our process is 75% the founder, 25% their understanding of the market. So the number one reason I pass is actually either the person cannot tell me a compelling story about the market, or their view of where the market is going is fundamentally at odds with mine. Here's a perfect example. I met someone the other day who's building a marketing automation technology startup. I'm like, the world doesn't need any more of these. I'm sorry if I offend anybody in the room. Like, there's hundreds of these. This is so, and he gave me like, this is our differentiation. I'm like, that is so narrow. There's so many companies doing this. Like, this is just not a good pool in which to swim. And so, like, most of the things that we do come down, because most of the founders that meet, I'm like, you're plenty capable. I just think you're pointed at the wrong thing. Or I met someone else who said, look, I think, car ownership in urban areas is going to go up. I'm like, I think it's going to go down. And so if your business is predicated on car ownership going up in urban areas, I'm not the right investor for you because I don't believe like your core. This was a parking related startup. I'm like, I don't buy your core thesis.
Yeah, no, I had that with Lux and Test Loop, and I was like, you're driving people for free, but I think that Tesla's not going to let you supercharge for free if they know you're doing a commercial thing. And they're like, yeah, no, they're totally not going to do that. And I was like, I know Elon, and I don't think he's going to go for that. Like, no, we have the blessing. And I'm like, no, you don't. And sure enough, they just got banned.
Yep.
And Tesla's like, by the way, if you're abusing the Tesla supercharger system, we're just going to turn you off. And you can sue us.
Because we can.
Because we can.
Yep.
Good luck in court.
Yep.
Okay, let's hear it for Charles.